Good day, class! Ang ating pag-uusapan ngayon is about tax risk management. At ang gagamitin nating reference ay isang napakagandang article from the website Finance Strategies. At ang sumulat ng article na ito ay walang iba kundi si True Tamplin, ang isa sa mga pinakagusto kong authors. At in-update niya ang article na ito noong July 2023. At si True Tamplin, siya ang author ng napakagandang books na Raising an Executive at The Handy Financial Ratios Guide. Alright, start tayo sa discussion. Tax risk management is the process of recognizing or identifying, evaluating, mitigating, or reducing risks associated with taxes that could affect both companies and individuals. This procedure is designed to reduce the possible consequences of tax risks, such as financial penalties, legal issues, and damage to reputation. Effective tax risk management is vital for both businesses and individuals to adhere to tax laws and regulations, minimizing the chances of facing financial penalties and legal consequences. A strong tax risk management strategy can improve a company's image and play a role in achieving lasting financial security. A successful tax risk management plan includes various important elements like identifying and evaluating tax risks, putting in place suitable measures to reduce risks, and regularly monitoring and reviewing tax risks. This thorough strategy assists businesses and individuals in preventing possible tax problems and adhering to constantly evolving tax laws and regulations. Talakayin muna natin ang tungkol sa compliance risk. Ang una ay ang filing errors. Filing errors are mistakes that occur during the process of preparing and submitting tax returns, such as entering incorrect information or making calculation errors. These errors can result in inaccurate tax reporting, which could lead to financial penalties and more scrutiny from tax authorities. O kasi magdududa ang mga naka-assign at baka mas iimbestigahan nila ito ng malaliman. Kaya mahirap yung may mga pagkakamali sa pag-file ng tax. Ang pangalawa ay ang late or incomplete reporting. Failing to submit tax returns or required documentation on time can lead to fines, penalties, and interest charges, which can have a detrimental effect on the financial status of a business or individual. Ang pangatlo naman ay ang incorrect tax classification. Misclassifying income, expenses, or transactions for tax purposes can lead to incorrect tax classification, causing either underpayment or overpayment of taxes. This mistake can also result in financial penalties or legal consequences for business or individuals. Isunod naman natin ang operational risk. Unahin natin ang changes in tax legislation. Modifications or alterations in tax laws and regulations, known as alteration in tax laws, can have an impact on businesses and individuals. To avoid possible financial and legal implications, it is crucial to stay updated and in compliance with these legislation alterations. Ang pangalawa ay yung cross-border transactions. Cross-border transactions encompass international trade, international investments, or international operations that are susceptible to diverse tax laws and regulations. These activities can pose tax challenges because of varying tax regulations and the possibility of double taxation. Next is the transfer pricing. Transfer pricing is the practice of setting prices for transactions between entities that are connected within a multinational corporation. Tax authorities closely monitor these transactions to make sure pricing rules, which can result in tax implications if not handled correctly. Ang susunod ay ang reputational risk. Tax controversies, that's the number one. Disagreements with tax authorities can arise when there is a dispute over a business or individual's tax practices or positions. These disputes may result in audits, investigations, or legal proceedings, which could harm the reputation and financial stability of a company or of a person. Next is aggressive tax planning. Aggressive tax planning refers to the use of tax strategies that stretch the limits of tax laws and rules in order to reduce tax obligations. Engaging in these behaviors could capture the interest of tax authorities and lead to adverse outcomes such as financial penalties and damage to reputation. Corporate social responsibility, or the so-called CSR, involves a company's dedication to behaving ethically, promoting social well-being, and ensuring environmental sustainability. Questionable or overly aggressive tax practices can undermine a company's CSR initiatives and impact its reputation negatively. Next is the tax risk management framework, identifying tax risks. Number one, internal risk assessment. Evaluating a business or individual's internal procedures, internal policies, and practices is part of internal risk assessment and is done to pinpoint possible tax risks. This evaluation assists in identifying areas that may need adjustments or modifications to adhere to tax laws and regulations. The second one is the external risk assessment. External risk assessment involves analyzing outside elements like alteration in tax legislation or rules that could affect the tax responsibilities of a business or of a person. Isunod naman natin talakayin yung assessing tax risks. Ang una, yung probability of occurrence. Evaluating the possibility that tax risks may happen requires making an estimation on the probability of a particular tax risk becoming a reality. Having insight into the probability of different tax risks can assist businesses and individuals in deciding where to focus their risk management efforts and how to best allocate their resources. The second one is the financial impact. Assessing the financial repercussions of tax risk entails gauging the possible monetary outcomes of tax mistakes or non-adherence, including penalties, fines, and interest fees. This evaluation assists businesses and individuals in determining the possible seriousness of tax risk and deciding on the best ways to address them. Next is the reputational impact. Evaluating the reputational consequences includes taking into account the possible harm to a company's or person's reputation because of tax controversies, aggressive tax planning, or failure to comply with tax regulations. Businesses and individuals can safeguard their reputation by being aware of the potential reputational risks linked to tax issues and taking necessary measures to respond accordingly. Sunod nating pag-usapan about mitigating tax risks. At ang una ay ang implementing internal controls. Setting up internal controls involves creating systems and protocols to oversee and handle tax risks efficiently. These controls are crucial for adherence to tax laws and regulations, minimizing the chances of inaccuracies, tardy submissions, or other tax-related problems. Next is developing tax policies and procedures. Crafting tax policies and procedures entails establishing a detailed framework of rules and directions to oversee tax related tasks within a company or for an individual. These policies and procedures are designed to promote consistent tax practices and minimize the chances of making tax errors or failing to comply with regulations. Next is training and education. Offering continuous training and education about tax laws, regulations, and optimal practices is essential to ensure that employees and individuals comprehend their tax duties and accountabilities. This kind of ongoing training can play a significant role in preventing mistakes, enhancing compliance, and minimizing tax-related risks. Ang susunod is about the monitoring and reviewing tax risks. Ang una, regular risk assessment updates. Regularly updating risk assessments involves reviewing and revising tax risk assessments to keep them up to date and precise. These updates provide businesses and individuals with timely information on changes in tax laws and regulations, allowing them to proactively manage emerging tax risks. Next is compliance audits. Compliance audits consist of examining the tax practices, the records, and reporting of a business or individual to verify adherence to tax laws and regulations. These audits are valuable for spotting possible problems, enabling prompt adjustments to be made. Next is the continuous improvement. Consistently analyzing and improving tax risk management includes consistently assessing and enhancing tax policies, procedures, and internal controls to make them more effective. This continuous procedure aids businesses and individuals in adhering to tax laws, regulations, and reducing the risk of tax-related issues. Ang susunod ay tungkol sa role of tax professionals in tax risk management. Number one, tax advisors and consultants. Tax advisors and consultants offer specialized advice on tax regulations, laws, and strategies, helping businesses and individuals tackle intricate tax matters. reduce tax burdens, and maintain adherence to tax laws. The second one is in-house tax departments. Company tax obligations and risks are handled by in-house tax departments. They create and put into action tax policies, procedures, and internal controls to guarantee that the company follows tax laws and regulations while also reducing tax liabilities. The third one is the external auditors. External auditors conduct an independent review of a company's financial records, tax documents, and internal procedures to verify accuracy and adherence to tax laws. Their unbiased assessment can pinpoint potential tax liabilities and suggest ways for a company to enhance or improve its tax strategies. Ang susunod ay ang tax risk management best practices. Ang una ay proactive tax planning. Proactive tax planning is about looking ahead to identify possible tax issues and creating tactics to mitigate them before they become a problem. This method assists in ensuring that businesses and individuals follow tax regulations, decrease tax obligations, and steer clear of expensive tax disputes. Number two is transparent communication with tax authorities. Open and honest communication with tax authorities includes discussing tax positions, transactions, and interpretation of tax laws. This approach can prevent misunderstandings, foster collaboration, and lower the chances of disputes or investigations. Next one is the collaboration with tax professionals. Working together with tax experts like tax advisors, consultants, and external auditors can assist businesses and individuals in efficiently handling tax risks. These experts offer valuable knowledge, direction, and assistance in dealing with complicated tax matters and making sure that all regulations are followed. Next is keeping up to date with tax law changes. Remaining knowledgeable about updates in tax laws and regulations is crucial for managing tax risks efficiently. Both businesses and individuals need to regularly adjust their tax practices, policies, and procedures to meet changing tax demands and stay compliant. It is crucial for businesses and individuals to have effective tax risk management strategies in place in order to ensure they are following tax laws and regulations, reduce tax obligations, and safeguard their reputations. Having a well-rounded tax risk management strategy in place can lead to various advantages, including better adherence to tax laws, lower tax payments, a stronger public image, and lasting financial security. Having a carefully planned strategy allows businesses and individuals to anticipate and address potential tax risks, ultimately helping them reach their financial objectives. Tax risk management is an ongoing practice that necessitates constant supervision, assessment, and improvement. It is essential for businesses and individuals to keep up to date with tax laws and regulations, adjust their tax strategies as needed, and collaborate with tax experts to guarantee ongoing compliance and risk management. Get in touch with a reliable tax advisor or consultant to create a thorough and forward thinking strategy for managing tax risks that is customized to fit your specific requirements. And to properly handle uncertainties, inexplicable and unexplainable business, legal matters, ambiguities, whatever you want to call it, that come with taxation. Because these uncertainties lack clear cut solutions, managing tax risks requires recognizing the potential risks and making judgment on how to address them.